All right, everyone, what's going on? This is Ryan, aka Cantor and Clark, and on behalf of my partner Josh Rager and I, we just want to thank you for tuning in to the BlockRoots YouTube channel. You know, we've grown tremendously recently, and we could not have done it without each and every single one of you. So we absolutely appreciate all of our followers, and we try to give back as much as possible. Each week, we try to give away hundreds of dollars in Bitcoin to lucky subscribers who leave comments on our videos. So this video, just like most of our videos, as long as you are subscribed to the YouTube channel, if you leave a comment below, you will be entered in to win $100 in Bitcoin. And remember, this is not a contest. It's essentially a lottery, and all you have to do to be entered in is be a subscriber and leave a comment. So in this video, we're going to talk about a few things. I want to touch on my most recent video that I did where we talked about Goldman Sachs client call. Now, that video was done before the client call. So obviously now the client call has taken place and we have an update on that. I'm going to give my opinion on that, and you know, this is not surprising at all, but we're going to get into that, and it's worth talking about. Then we're going to talk about higher time frame analysis of Bitcoin, where we currently sit, what I am looking at, what I am thinking. And then lastly, I want to give you a way that you can look at alts, because there are a lot of alts that are making big moves across the board, and I want to make sure that you are in the best position to sort of make the right decisions with regards to how to play these opportunities. All right, because many of them are pumping due to the fact that they have a certain liquidity profile or lack of liquidity profile. And the last thing that you want to do is get burned chasing something that has the bulk of the move behind it. So we're going to look at alts, and rather we're going to go over a way to look at alts. It's a very simple method to use. Rather, it's a very simple, I want to say, standard to sort of invoke. And then we'll wrap it up. So we'll try to keep this short. For those of you that follow us, you understand that we are partners with Famex. So head over to Phemex.trade to check out the exchange. They just added in feeless spot trading. So prior to this, they offered perpetual swaps. So these were contracts or derivatives that offered up to 100 times leverage. And now they offer spot and USDT. So if you're afraid to trade derivatives or afraid to trade contracts or perpetual swaps, now they offer spot. So you can deposit spot BTC, ETH, XRP, Link, and they are adding or plan on adding a ton of other assets as well. So Phemex.trade is phenomenal. Josh and I are partners with them. We work directly with them. All right. But needless to say, they are the fastest crypto exchange. And I think that they are the most professional option out there right now. And likely, if you ask me, they'll probably be taking the #1 spot within the next year. So let's talk about that Goldman news. All right, so I have a Financial Times article up, and then I have a tweet that was put out recently, and you guys have probably seen this shared, you know, ad nauseum since the call ended. And the Financial Times article is headlined that Goldman Sachs betrays Bitcoin. All right, so essentially the Goldman Sachs call was titled, you know, Goldman Sachs, Bitcoin, gold, and I think inflation. I forgot what the name of the client call was, but essentially talking about how, you know, the idea was that maybe Goldman Sachs would sort of be validating the role that Bitcoin plays in this economy, right, in this global macro economy, and drawing a similarity between it and gold. All right, as in benefiting from being hard assets, from being uncorrelated, from being a hedge during these kind of catastrophic times. And that's what we are experiencing right now. There is a lot of unrest across the globe, right? So, you know, I hope we say this enough. We hope no matter what, more importantly than anything else is your health, your safety, your family. So more important than crypto and Bitcoin, we hope that all of you are doing well in these times, because they are tough times. All right, but during times of unrest, gold tends to benefit, right? Because it is a store of value. So the parallel that many assumed would be drawn would be that, you know, Bitcoin was sort of this new era gold. All right, so this was before the client call, because apparently their clients have likely expressed a lot of interest in Bitcoin. All right, so if you want to take a look at this article, feel free, go to Financial Times, Goldman Sachs betrays Bitcoin. All right, we're looking at David Solomon right there, the guy who I said was, you know, a pretty progressive CEO in terms of him moonlighting as a DJ. We obviously know that, and here's some of the responses you see. We obviously know that he's not a DJ, for in terms of working as a DJ, but it's just an interesting thing that he's this progressive CEO who likes to DJ sort of techno house music. And you'd think that if there was one CEO to really change the positioning by, again, one of the top players on the top of the totem pole in the financial universe, it would be a CEO that was a DJ, right? But we have not seen that. Instead, Goldman came back with this sort of I wouldn't say it's an abrasive response, but it definitely is not in defense of Bitcoin. It is still kind of on the attack. So here is the summary that we saw post client call. Cryptocurrencies, including Bitcoin, are not an asset class. All right. So for a few points, some of them are so obvious that it just seems like someone who is a very junior level employee came up with this, right? Put this PowerPoint together. So do not generate cash flows like bonds. This is obvious, right? Do not generate any earnings through exposure to global economic growth. All right. It's not an equity. Okay. Right. It's not a share of a company. Do not provide consistent diversification benefits given their unstable correlations. I would say that this is false. Okay. Because recently there was a correlation with global assets, right? But this was during a period where all correlations essentially went to one, right? Across the globe, there was a major deleveraging. And I would say that up until this point, Bitcoin has proven that it is largely uncorrelated, all right? And if anything, it is a lot less correlated than any other asset. What we are seeing is during times of stress, like we've seen recently with global markets, that almost all other assets now are correlated to some degree or another. It's very difficult to find something that is not correlated at all. So I think if there's one asset that's done a really good job, and like I've said, this could be due to the fact that it is small, that it is so small, right? It's insignificant still in terms of its presence on the global stage. It's also due to the fact that it's not shared on something as simple as it's not shared on traditional brokerage platforms. If you're on TD Ameritrade, if you're on Charles Schwab, you cannot just go from, bonds to Forex to equities and then to crypto, right? You could do that with all of those other assets, but you cannot go between crypto and any of them on the same platform. So they're not as connected to sort of these tools that allow traders to get in and out and to really manifest these, I would say to really manifest the negative correlation trades, right? If you're on a platform and equities are crashing, you could get right into something that's non-correlated, rather that it has an inverse correlation. So we don't see that, right? It says do not dampen volatility given historical volatility of 76%. Yes, we know that Bitcoin is a hyper volatile asset, but we have to look at it from a risk-adjusted return standpoint. Okay, those drawdowns are worth taking when you look at sort of the asymmetric upside that is involved and has been involved previously with the asset. Okay, moving forward, maybe that's not to be expected. All right, the same level of growth, but still, we have to look at things from that standpoint. Do not show evidence of hedging inflation. All right, I think it is too soon to say that. All right, we're still kind of in the first few innings, right? We believe this is the worst one, I think. We believe that a security whose appreciation is primarily dependent on whether someone else is willing to pay a higher price for it is not a suitable investment for our clients. I don't know any asset that does not do this, right? This is pretty much what the appreciation of all assets boils down to. Now, you could say that, at some point equities have a floor, right? They do have a floor at some point. But it is still a greater fool theory, right? It is the greater fool theory that you're constantly looking for someone else who values the asset slightly more than you do, and you're looking to sell to them who are willing to buy higher. This is how all things work. How do assets move up and down? Well, they move up when there are more aggressive buyers than sellers, and they move down when there are more aggressive sellers than buyers. Everything is essentially a two-way auction. So I thought that this was the most ridiculous point that they made. And then the last point they made, we also believe that while hedge funds may find trading cryptocurrencies appealing because of their high volatility, that alert does not constitute a viable investment rationale. Well, it does not maybe constitute a viable investment rationale when you're framing it, putting in a framework of long-term stable returns. But the fact is that more hedge funds getting involved, they just shed more light onto the entire asset class as a whole, which will bring more investment hopefully, and then increase the overall moneyness of these vehicles. And by moneyness, I mean the the property that the asset takes on that makes it a little bit more stable takes on sort of a money-like quality, right? Sort of like a currency, if you think about USD. So equities took on a money-like quality as of the last few years, which is not necessarily a good thing, because this is when there is a lot more short volatility at play, all right? And this is what ends up breeding or setting up these large deleveraging moves and these large standard deviation disturbances that we've had recently. And this is, because when there is little or less yield to be found, people add on more leverage, try to squeeze as much juice out as they can when there's, very little left. So assets take on a sort of money-like quality and they achieve moneyness. So this is very, I found this kind of juvenile and ridiculous, and it's kind of, some of these points are very obvious. Goldman Sachs, the most obvious thing is that Goldman Sachs has their own business to protect. They have skin in the game. And if their clients express interest in something that does not require them to be a counterparty and that they are currently not involved in, well, then that's just less business for them to gain. There is no spread for them to gain. They are not currently offering Bitcoin to their clients. There are no fees for them to collect. So this is something that is dangerous for their business. And, essentially you have to think about it as it's a conflict of interest, right? So of course they're going to say this during a time like this where people might feel less certain about these larger financial services and keeping their money in traditional assets. So they're expressing, I think, a very root human behavior, which is fear. Right? They're expressing the very obvious human behavior, or very obvious core behavior, which is fear in this case, fear for their own business. So that's that. I wouldn't expect them to change their tune within the near future until it becomes imperative for them to do so, where they have, it's for them to get involved, or they will not survive. But that is thinking kind of extreme, and I would not expect that in the near future. As much as I drink the Kool-Aid with Bitcoin, things are not changing on the large scale anytime soon with regards to the priority towards certain traditional assets. If you look at the S&P 500 right now, the fact that it is rising in this sort of economy, one, it just shows you how disconnected markets can be from the economy, and two, the more you look under the hood, you realize that that's the the assets that are responsible for the index rising the way it is, or it's just a handful of assets, right, carrying most of that. So this was kind of silly and ridiculous, and I think we can move on from that. So I want to look at Bitcoin right now. All right, I've said many times before, we have to identify the major levels within market structure, and I've referred to them as levels where we see a ton of participation come into the market, major contextual levels where there's contextual risk reward. Okay, sometimes I might overcomplicate this, and I might lose some people in just I don't want to be heavy on the jargon, because I think, to me, it's natural. But what I'm saying is, we're looking at the market and we're seeing that there is a consistent level through time that has been defended, right? It is stopping upward progress. We're looking at this level up here from right now. It's a little bit lower, I'd say, around 9,800, but you're looking at from 9,800 to right around 10,500. All right, this is a major contextual level. This is a level where we see participation come into the market from all participants. All right, we see an increase in participation, rather, or an increase in involvement. And this is because this is a level where we can expect an increase in selling pressure from anyone who has longed from within this structure on the way up, and also because a lot of larger position traders might have defined their risk. If they are currently short, this is where they're going to be defending, because this is where market structure changes greatly. This is a contextual good level to short if you are not currently short, because it's a good level to define your risk. Right? When you're defining your risk, when you're placing a stop, you're placing it in an area that invalidates the thesis that you have. And if in this case, your thesis is that market structure is bearish and it's remaining intact, well, then your thesis changes if the market moves up above this previous high. So it's a good area for this risk to reward to be defined, in that we're very close to this level. And that obviously you want to be able to have a tight stop so that you could put as much juice behind the position as possible. So until this level is broken, you just have to kind of swallow your pride and bite the bullet, right? And bite the bullet meaning it's very easy to sort of get caught up or captivated in this bullish euphoria that we have as we are continuously gunning towards this level. Because you think of it as, we're chipping away at this level. And absolutely, as we continuously approach a level and grind away at it, there is a higher probability that it is eventually going to give way. But if we're experiencing absorption and weakness going towards that level, then it's best to just exercise with a degree of caution and say, I'm not going to get involved until we break this level, which is extremely close if you think about it. To get involved right here, it is almost, you're letting greed overtake your decision-making process, right? So this 9,800 level, this is fairly important because it is the last 7-day range composite value area high. So I'm always trying to find developing value. That's what we teach in BlockRoots. And developing value, the value area high, was the high of that composite period. Okay, so we have this high within market structure right here. We have the developing value high. And in this case, this is the level that we're seeing absorption and that we're seeing buyers begin to sort of lose momentum the last few times. So until this level is broken, it's just best to either sit on your hands, excuse me, I'm having some trouble with the drawing tools, to sit on your hands and wait, all right? Or, like I said, if your bet is that the level is not going to break, this is a good level contextually to place a short position. And I'm not saying, to go ahead and place a short position. I'm just saying, objectively speaking, from a risk to reward standpoint, it's a good level for you to be able to define your risk if you are taking a short position. I don't think that this is inherently bullish or bearish at this moment. Again, it's the umpteenth time, and that's just my way of saying, this is the, 1, 2, if we look back here, if you're looking at this entire structure, we've approached this level multiple times before, and this was a very bullish move off of the lows. If there is one asset to make this kind of move, though, it is Bitcoin, right? It is a highly reflexive asset, and it moves quite quickly. And, that can be interpreted as very bullish and likely to have follow through. And then a lot of times we see that it'll just roll over and retrace a majority of the move. So until this 9,800 level is broken, I would say that, I'm going to be sitting on the sidelines for any longer term positions to the upside. Now, as we came up towards this high, if we're looking at this from the last 4 weeks, this is what we're looking at. These are the distributions. This is the distribution of price movement over the last 4 weeks. All right, this is how it is organized, right? And TPO just helps you organize the data. So we can see that we've been stuck almost having these inside weeks for the last 4 weeks, with exception for this current week there we are rotating within. So when we combine these, we get this composite, which helps us identify that level is right around 9,800 for the value area high. And what that means is essentially this is the level that we have consistently auctioned up to and either been absorbed at or lost momentum and fallen from. So until we break this level and gain acceptance outside of this level, nothing really has changed. Price can continue to, auction within a value area, rotate within a value area. And that's why it's really important to not just look at any point in time, but to look at the bigger picture as a whole and to see where we've been distributing through time. So 9,800 level is the key level to me. In terms of moves to the downside, loss of market structure within the structure, so losing, for example, 9,400, just opens up immediate structure. I'm not going to say, we lose this low right here and we're immediately coming down here. I'm not going to even say that if we lose this low, we're coming all the way down here as well. I would just look at the immediate market structure. In this kind of environment that we're experiencing right now, it's easy to get caught off sides. That's what we're seeing at the top. There's a lot of volume coming in toward this top. And then what this volume is allowing, what this volume is causing is these unwinds where, buyers are caught at the top, they're stuck in position, and as soon as we begin to pressure them a few percentage away, we start to get into that really densely populated zone for position for traders where maybe they're outside of 50 times leverage, outside of 100 times leverage, and it's getting to more conservative amounts of leverage where a majority of the stops are. So you could start to see this stop cascade occur. So moves to the downside, though, I'm still just looking at immediate levels within market structure, and I'd be looking at range composite levels. So I'm looking at 8,900, 9,400 from where we currently are, and then 8,500, right around that level. And then only through 8,500 do we begin to, or rather 8,450, do we begin to have a gap that opens up with a little bit less resistance and more of an air pocket. Okay. in between here, I can't really see anything that would stop price until we get down to 7,500. But until that point, there are not many acceleration zones, which is something we teach in BlockRoots. Find the levels where, or identify levels where price might accelerate through. So until we see that, play it level to level. The most important level for upside action, you could take intraday longs off of these levels, but the most important level for upside prolonged action that probably would have a good amount of follow through, because at this point we would more than likely trigger a lot of buy stops and short covering, is probably around 9,800. All right. So moving away from Bitcoin, the last thing I want to touch on is playing alts. The most important thing with alts, in my opinion, is that one, they're liquid, so we're not chasing something that's extremely liquid, and two, that they have volume. And we've seen, that these two features often go together. It's not guaranteed that just because something has, high volume that it is liquid. It might just previously have had, a high 24-hour volume, but liquidity could dry up. It's not always that, one is present with the other. But with alts, the safest bets are within the top 10, top 20. You're going to find that these are heavily traded, and then we begin to drop off. The alts that are flying, you could see that they make large moves up, like Theta, just one of many, but then all of their liquidity dries up. So if you look at the order book, there's really nothing stopping this. On the way up, you have a strong bid, but as soon as we peak, there's really nothing standing in the way for quite some time. So you could just look at the fact that there are not many resting orders or passive orders on this order book to really support price on the way down. And with alts, it's so ingrained that when they put in a top, and everyone starts to catch on that the top is potentially in, that fear and that sort of the hesitation that comes with that fear really just pulls any kind of orders off of the book that would potentially step in the way on the way down. And we see that it becomes very self-fulfilling, that alts come all the way back down to the range in which they left. So when I'm looking at alts, the most important thing to me is weekly structure. All right, so what I do is, after identifying that an alt has a substantial amount of volume, we're talking at least over, in my opinion, at least over $5 million in volume, and that the alt is, for example, we're just going to go to Nomics. So we have volume and the market cap. You want to make sure that the market cap, in my opinion, is over at least $200 million. Obviously, the lower market caps, they imply that there's potential more upside, more growth, low supply, low market cap. But without getting into that, what I like to do is look at things on the weekly time frame. So we'll go to Algo, for example, because I think that this is something that has painted a very clean structure. So what I do is I go into the weekly time frame and I'm identifying the major weekly levels. And you'll see that alts have many times put in their own historical low, gone on to move upward, lost that low, and then treated it as resistance. That weekly low that should now act as resistance is the next area that I need to see act as support on the daily time frame for me to get into any type of long position. So Algo is the perfect example, because we had, for the longest time up until the end of 2020, we had weekly structure that was bottomed out. This is a new asset. We have a very clear level, and it's not it's not precise as in it's been one level the entire time, but it's been a general level, right? So we have a general level down here where price has consistently wicked down and returned from. You have a very clear weekly structure right here is the swing low below those levels. All right, you call that a deviation if you want. I'm not a price action trader, but that is a popular phrase within price action traders outside of this range, right, where traders get trapped and we get a very responsive move to the opposite direction. So whether we're using this low or this weekly low, just extending these forward, and then what we'll do, and we're going to wrap this up after this, is we will extend this forward and then begin to look for the structure to build on the opposite side of this. And this is what allows you to build sort of a default approach to alts. So you say, if we are below this weekly level, then I am potentially just a buyer to that level. And the only time that I'm willing to, and this is speaking for myself, put on longer term positions is when we've overtaken previous market structure. So when we've overtaken this level and created support above this level. So you're looking at something, you could have assumed it was right here, and you would have essentially been wrong in this trade, but many times you're going to be wrong. And then you have structure again to the set for the second time, potentially making a stronger case in that there was a more aggressive move through the level, and now we're treating it and as support and getting bid up much sooner rather than having this immediate correction as soon as we gain acceptance. So going through alts, this is what I would do. I would essentially identify my weekly structures. Here's algo against BTC. Right, so we just looked at the algo USD chart. We're looking at what the story has been, right? So for the longest time, this was higher time frame support. So we're going to attach it based on these lows. Okay, you can even move this up slightly if you're, again, going to be a little bit more conservative and require price to give you a little bit more confirmation. But now we have the major levels within structure that we have respected for quite some time. And we finally lost them right over here. So the story changed right here. The only way that this story changes again is when we are back above these levels. So it's just one of the safer ways to approach the market. It's very basic, right? We're just looking at market structure and saying, for the longest time, these were our weekly lows. The thesis was that taking longs off of these lows was a valid trade. Okay, this was a good area to find risk. This was a good level for contextual risk reward every time we approached it because we had not had new lows at this time. Once we break this level, we make new lows. So we define this level now as resistance. So if we begin to base out lower, all it opens up is a trade back to this level. The larger trend potentially shifts when we are back above this level. So that's all I'm saying. The alts that I am looking to trade are things that are doing this, that are back above major levels within market structure that they've previously treated as support, that have since then been treated as resistance and are now again treating as support. So that's as simple as I try to keep it. I think that that's the best way to approach it. It's a very formulaic way of looking at the market. If this, then that. And it just boils down to higher time frame market structure. And this is important because with alts, you have a lot of these large moves on the small time frames, on the low time frames, and then they just give up a majority of that move because, again, they are liquid and they're not able to hold on to those gains. So it's not really that the trend is changing. It's just, we're misinterpreting, movement for meaning or volatility for meaning. And it doesn't mean much unless it occurs on the higher time frames. So that's that, guys. Hopefully that has been informative. I'm going to try to wrap this up. We're slightly under 30 minutes. I let it run for a little while longer than I wanted, but everyone have a fantastic weekend. I hope you're all doing well in these tough times, and always feel free to reach out to Josh and myself, get to know each of us a little bit better. And until next time, as always, exercise proper risk management and trade effectively.